Sometimes the best thing to do when it comes to investing is figure out what not to do. Because you can learn from mistakes in investing, they just don't have to be your mistakes. So today, we're gonna talk about some of the worst investing mistakes that you can make and how not to invest. So the first one is waiting for the dip. So there was an article written, I'll leave it down below, on dollars in data. And what they found was that people who waited for the dip, even if you were God, meaning even if you knew the lowest point of the dip, still performed worse than people who just dollar cost averaged 70% of the time. So waiting for the dip historically has shown that is one of the worst things that you could do. Instead, what you should be doing is allocating a certain amount of money every single month, putting it into the market and continuously investing. For me, I know personally, I have missed out on so many opportunities waiting for good companies to pull back instead of just investing in companies as they're going up. I thought to myself, it's not going to go any higher. Why should I keep investing money in a company that's going up? Instead, I'll just wait for a pullback, then I'll start investing my dollars. I've lost so much money by doing that, and I learned this the hard way. So what I want to do now is teach you guys this is not the way to go. Investing in the dip is not the best thing to wait for. Instead, allocate your dollars every single month so that you can perform at your highest in the market. The second one is selling too early. One of the biggest things that you can do is making sure that you buy and hold good companies. And if you're buying and holding good companies over a long period of time, you are bound to make money over time. And some of my biggest mistakes have been selling great companies too early. Unless a company has a terrible financial statement or something is going terribly wrong on the financial side, then it's still going to be a good company with good management over time. And rushing to sell is just an emotional mistake. If there's a recession or some sort of short-term dip, there's no reason to sell. Making sure that you keep your money in good companies or keep your money in good index funds over time allows you to reap the benefits of compound interest and build tremendous wealth. The next one, fear and emotions are the enemy of investing. So I saw so many people, when the recession hit, they started to panic and sell all their stocks. This is one of the worst things that you can do, because what is the biggest investing mantra that everybody talks about? Buy low, sell high. And if your emotions get in the way, then you're gonna be selling low and buying high, which is the opposite thing you wanna do. So removing emotions from your equation when it comes to investing is one of the biggest things that you can do. How do you do this? One of the ways is to not look at your portfolio so frequently. The portfolio is gonna go up and down day to day. And if you're prone to getting emotional, you feel your heart flutter up when your portfolio is down 1 to 2%, then this is something you don't wanna be doing. Instead, look at your portfolio every quarter or every year and start investing over time in some great companies. The fourth way not to invest is trying to time the market. I don't have a crystal ball. You don't have a crystal ball, so trying to time the market is a major mistake when it comes to investing. Nobody knows which direction the market is going to go, so making sure that you're investing and allocating dollars every single month consistently over time is how you're going to get rich in the market. Because when you try to time the market, you lose out on gains. Say, for example, you're trying to buy a stock for $60, and right now it is at $70. Well, waiting for that to pull back to $60 is a fool's errand. As we talked about, we're not trying to buy the dip, because what happens a lot of times is that stock's gonna go from 70 to 80 to 90 to 100, especially if it's a good company, and you lost out on all those gains just waiting for a $10 pullback. So if you try to time the market, you lose out on massive gains. The next one, panicking in a recession. So like we talked about, the goal is to buy low, sell high. And what happens in recessions, and I've seen so many people do this, is they start to sell off their stocks, panicking in recessions. This happened a ton in 2007, 2008, in the Great Recession, where you saw a lot of people lose a lot of money because they sold within the Great Recession when everybody was selling. Instead, what you want to do is be fearful when others are greedy and greedy when others are fearful. That's a famous quote by the best investor of all time, Warren Buffett. And what he means by that is be fearful when others are greedy. So be fearful when the market gets too high. But what we talk about here is just start to consistently invest, and be greedy when others are fearful, meaning start to put as much money as you possibly can when stocks go on sale in a recession, because that's what it is in a recession. Stocks are on sale. Whether it's socks or stocks, I like to buy things on sale. The sixth investing mistake that's going to cost you money is listening to people who try to predict the future. Because all the time, you're going to turn on the news, you're going to turn on CNBC, you're going to hear people on podcasts saying they know what's going to happen to the market in the future. People are going to say the market is going to go up, it's going to come crashing down. It's going to go in every which way, every single direction. You can turn on the radio, you can go all over the place. You're going to hear a bunch of people saying the market's going in two different directions on the same day. Nobody knows which direction the market's going to go in. Nobody has a crystal ball. Nobody can predict the future. And that's why it's extremely important to understand this and not listen to people who say they can predict the future. Instead, allocate your dollars every single month, invest in good companies and good funds over time so that you can build wealth. You can see there's an underlying theme here that if you consistently do the same thing, you're going to get rich. And the last one is trying to beat the market. So every single year, what happens is professional money managers, their main goal is to beat the market, as is everybody else. So what happens is 90% of them never beat the market. Now, these are professional money managers on Wall Street. They don't beat the market. What makes you think that you can beat the market? But out of the 10% that do beat the market every single year, it's never the same 10%. Meaning it's never the same fund managers year in and year out that are beating the market. So instead, what I like to do is I like to become the market. How do you become the market? You invest in things like low-cost index funds. You allocate a certain amount of money over time and continuously invest in those index funds. You can invest in things like the S&P 500 or the total stock market index, which all of these will allow you to become the market and reap the benefits of market returns. It turns out that you can be lazy and rich. Now, this is extremely powerful because all you have to do is allocate dollars every single month. You don't even have to look, because if you look at that stock market chart over time and you put a stock market chart on your phone, turn it sideways, put it on the longest time horizon you can, what direction does that market go in? It goes up. And that's the benefits that you're going to reap over time. And understanding this is so incredibly important. Listen, I hope you guys enjoyed this video. If there's some other ones that you would add, leave them in the comments down below. And don't forget to like, subscribe, hit that notification bell as well. And we'll see you on the next video.